On the morning of the 23rd of February, 1995, the oldest merchant bank in Britain opened its Singapore office and found a handwritten note on the trading floor. Nick Leeson was gone. Barings Bank, founded in 1762, banker to the British Crown, the institution that had financed the Louisiana Purchase, had 48 hours before it ceased to exist. The cause was a single account number. The account was called 88,888. Leeson had opened it himself, and for nearly 3 years he had used it to hide losses that his superiors in London had no mechanism to detect, no authority to audit, and in some cases, no apparent curiosity to investigate. The question this episode is here to answer is not how he lost the money. It is how the institution allowed it. About 10 minutes from now, there is a single paragraph in the Board of Banking Supervision's 1995 report, one paragraph, that answers exactly why this happened and why it was allowed to happen again. When we get there, you will understand why that paragraph is the most damning sentence in the entire document. Barings in 1992 was not a bank in crisis. It was old, founded in 1762, older than the United States, well regarded, and in the middle of a deliberate expansion into Asian derivatives markets. Barings Securities, its trading arm, had opened offices in Tokyo and Singapore. The Singapore International Monetary Exchange, SIMEX, had been founded in 1984, and by the early 1990s had become a significant venue for futures contracts on the Nikkei 225, the Japanese stock index. It was, in other words, exactly the kind of exchange an ambitious bank wanted to be on. Nick Leeson arrived in Singapore in 1992 as a floor trader. He had come up through settlements, back office operations, and had failed the Series 3 exam that would have licensed him to trade in the United Kingdom. In Singapore, the regulatory threshold was different. He passed. He was given a trading license and authority over Baring Futures Singapore's operations on the SIMEX floor. London sent him anyway. That detail matters. What happened next was, from a structural standpoint, elementary. Leeson was appointed general manager of Baring Futures Singapore. He also retained supervisory authority over the back office, the settlement and reconciliation function that was supposed to monitor his own trading positions. One person, 2 desks, no independent check. The institution had, without apparent awareness, constructed a perfect closed loop. This arrangement was not unique to Barings. It was not invented by Leeson. It was a cost decision, almost certainly made by someone in London who understood the profitability potential of the Singapore desk and was less focused on the operational architecture underneath it. The person who made that decision is not named in the subsequent inquiry. Their name does not appear in the historical record at all. Between 1992 and 1994, the Singapore desk was reporting extraordinary profits. Leeson appeared on paper to be generating returns that London was glad to receive and not especially motivated to interrogate. The profits were real in the sense that they appeared on reports. What the reports did not show was account 88,888. Account 88,888 was opened in July 1992, approximately 3 months after Leeson arrived in Singapore. The stated purpose, according to the internal documentation Leeson provided at the time, was to handle error trades, minor discrepancies from settlement mistakes made by junior staff. Error accounts of this kind are standard in derivatives operations. A trade booked under the wrong counterparty, a position entered with an incorrect quantity. You need somewhere to park the discrepancy while it is corrected. An error account is mundane. The name Leeson chose for it, 5/8, a number considered lucky in Chinese culture, was not. In about 3 minutes, we will look at the specific line in Barings' own reconciliation records that shows exactly when 88,888 stopped being an error account and became something else entirely. What was not mundane was that account 88,888 was excluded from the daily position reports sent to Barings management in London. Leeson had configured the reporting system to omit it. The account existed on SIMEX's systems, The exchange could see it. But it was invisible to Barings' own oversight infrastructure because that infrastructure relied entirely on reports that Leeson himself generated. He was, in effect, both the subject of the audit and the auditor. The first loss, entered into 88,888, was small, the equivalent of roughly £20,000, a genuine settlement error made by a junior colleague. Leeson absorbed it rather than report it. That decision, private, made in the first months of his tenure, never disclosed, was the originating act. Everything afterward was architecture built to protect that decision from the moment it became too large to survive exposure. By the end of 1992, the account held losses of approximately £3 million. By the end of 1993, £23 million. By the end of 1994, £208 million, more than the bank's entire disclosed capital reserves. Each of those figures had passed through Leeson's hands on its way to London. None of them arrived. The mechanism accelerating those losses after 1994 was Leeson's trading strategy. He had moved from concealing errors to actively trading, selling options on the Nikkei and buying Nikkei futures, effectively betting that Japanese equity markets would remain stable. On the 17th of January, 1995, an earthquake struck the city of Kobe. The Nikkei dropped more than 7% in the weeks following. Leeson's positions, which required stability to remain solvent, began losing money at a rate that account 88,888 could no longer quietly absorb. He doubled down. The losses accelerated. By mid-February, the account held losses exceeding £830 million, roughly £830 million against a bank whose entire capital base was approximately £440 million. The question of what Barings' management in London knew is where the historical record becomes genuinely uncomfortable, because the answer, when you read the documents, is quite a lot. The bank was, by 1994, transferring very large sums of cash to Singapore to fund the margin calls on Leeson's positions. Margin calls arise when a futures position moves against the holder. The exchange demands additional collateral to maintain the trade. In the year leading up to the collapse, Barings London transferred more than £500 million in cash to its Singapore subsidiary. The internal justification Leeson provided was that these funds represented collateral for client positions, trades made on behalf of clients whose own margin obligations Barings was temporarily covering. £500 million transferred on the word of one man in Singapore. The problem with this explanation, which several people in London received and transmitted upward, is that it was implausible on its face. A bank that is collecting margin from clients does not require its own capital to fund those margins. The entire logic of client margin operations is that the client's money stands behind the client's position. This was not obscure knowledge. It was first-year banking. Near the end of this video, we will come to the internal audit memo, completed 5 months before the collapse, that put this exact contradiction in writing and was filed without a single follow-up question. James Baker, the management accountant at Barings in London, raised this concern in writing in January 1995. He received a reply that characterized the Singapore operation as unusual but profitable, and the conversation appears to have ended there. Unusual but profitable. In a bank's internal correspondence, those 3 words have a way of closing doors that should stay open. The auditors present a similar picture. Cooper's and Lybrand's Singapore office conducted an audit of Baring Futures Singapore in 1994. They raised questions about the funding flow and about the concentration of responsibilities in Leeson's role. The final report, delivered in the summer of 1994, recommended that the dual role be separated, that the trading function and the back office function should not be held by the same individual. That recommendation was noted. It was not implemented. It would not be implemented for another 8 months, at which point there was nothing left to implement it in. The Bank of England's own supervisory framework at this period was, by its own subsequent admission, not structured to detect this category of failure. The bank supervised Barings at the group level, Baring Futures. Singapore was a subsidiary, regulated by the Monetary Authority of Singapore and reporting to SIMEX. The gap between group-level supervision and subsidiary-level operations was not a gap that routine reporting was designed to close. 3 separate regulatory bodies had sight of some portion of this disaster. None had sight of the whole. Peter Baring, then chairman, and Andrew Tuckey, the deputy chairman, were both interviewed extensively for the Board of Banking Supervision's inquiry. The report concluded that senior management had received sufficient information to question the Singapore operations' profitability claims and had not done so with sufficient rigor. Sufficient information. Insufficient rigor. The report did not use the word negligence. It did not need to. If you want to understand why senior management asked fewer questions than the available information warranted, the Board of Banking Supervision's inquiry gives a more specific answer than most regulatory documents permit themselves, and it is worth sitting with before we reach the collapse itself. SIMEX, the Singapore International Monetary Exchange, occupies a peculiar position in this story. The exchange's systems recorded account 88,888 positions in their entirety throughout Leeson's tenure. SIMEX could see at any given moment the full scale of the exposure held under that account number, and SIMEX did write to Barings 3 times, 3 letters, 3 opportunities. What happened to each of them is the part of this story that tends to get lost. In August 1994, SIMEX sent a formal letter to Barings noting the scale of positions being carried and requesting written confirmation that Barings was aware of the exposure and had adequate capital to support it. Barings confirmed in writing that it was aware and that the positions were appropriately capitalized. This was, in a formal regulatory sense, a satisfactory response. SIMEX's rules required confirmation. It received confirmation. The obligation was discharged. The letter was answered. The problem it described was not. This is the part of the story that the narrative of individual recklessness tends to obscure. Leeson's fraud was not invisible. It was visible to the exchange, partially visible to the auditors, and, in its financial consequences, visible to anyone in London who examined the cash flow between the parent bank and its Singapore subsidiary with any sustained attention. The question the historical record cannot quite answer is why no one looked for long enough to see it whole. What SIMEX lacked was the authority, and perhaps the inclination, to penetrate the management structure of a foreign bank subsidiary and demand an explanation of why a junior trader also controlled his own settlements function. That was, formally speaking, a matter for Barings' group supervisor in London. London had the information. London had the cash flow data. London had the auditor's recommendation. What London lacked was institutional urgency. And by the time it acquired one, the institution was gone. By mid-February 1995, SIMEX's margin demands had become extraordinary. On the 23rd, Leeson did not return to the office. He left a note on his desk that read, in its entirety, "I'm sorry." He and his wife left Singapore. Within days, Peter Baring was on the telephone to the Bank of England, and it became clear over the course of a single weekend that there was no rescue. The losses were total. The bank could not be saved. The Bank of England's response to the Barings crisis unfolded over the weekend of the 25th and 26th of February 1995. Eddie George, then governor of the Bank of England, convened discussions with the major clearing banks. The question was whether a consortium rescue, on the model of the 1984 Johnson-Matthey rescue, or the 1890 Baring Brothers rescue, which had in fact involved the same institution in an earlier iteration of distress, could be organized in time. Barings had been rescued before. The assumption, somewhere in the building, may have been that it could be rescued again. That assumption collapsed on the Sunday evening, and the single figure that ended the rescue conversation, the true size of the hole in the balance sheet, which we will reach in about 2 minutes, was larger than any consortium number discussed across that entire weekend. It could not. The losses were too large, the positions too uncertain, and the derivatives book too opaque for any consortium member to feel comfortable assuming the liability without a full audit that the timeline did not permit. The major banks declined. the Bank of England declined to use public funds. By Sunday evening, there was nothing left to negotiate. On the 26th of February 1995, Barings was placed into administration. 3 days later, ING, the Dutch banking group, acquired Barings for a nominal sum of £1. ING assumed the liabilities, retained the staff, and absorbed the franchise. The oldest merchant bank in Britain changed hands for less than the price of a newspaper. 233 years of Barings Bank ended at a price of £1 sterling, net of debts that exceeded the bank's entire existence as a going concern. The institution that had helped finance the Louisiana Purchase, that had survived Napoleon, that had been called the sixth great power of Europe, sold for a coin. Nick Leeson was arrested in Frankfurt on the 3rd of March. He was extradited to Singapore, tried, and sentenced to 6.5 years in prison. He served 4 years and 4 months, released in 1999, and subsequently wrote a memoir and became a public speaker on risk management. The man who destroyed a 233-year-old bank now charges a fee to explain why it happened. The Board of Banking Supervision, the body that formally investigated the collapse on behalf of the Bank of England, published its report in July 1995. It is, for a regulatory document, remarkably specific about blame. Most documents of this kind spread the weight so evenly that no single surface bears it. This one did not. The report runs to several hundred pages. One paragraph carries the weight of the rest. The true explanation of why Barings collapsed is that management teams have a duty to understand the businesses they manage, and if they do not and cannot fulfill this duty, they should not manage those businesses. That is not a technical finding about margin accounting or derivatives regulation. It is a sentence about governance, about the most fundamental obligation a manager has to an institution. And the board placed that sentence not in a chapter about Leeson, but in a chapter about Barings' board of directors and its senior management in London. The report did not say Leeson was not responsible. It said he was not the explanation. The report recommended immediate separation of trading and settlement functions as an industry-wide standard, enhanced group-level supervision of overseas subsidiaries, and improved communication between national regulators. The Financial Services Authority, which absorbed the Bank of England's supervisory functions in 1997, incorporated many of these recommendations into its operating framework. On paper, the lesson had been learned. The paper is where it largely stayed. And yet, the history of financial supervision after 1995 is not a history of uniform vigilance about exactly this failure mode. The concentration of authority, one person or one desk controlling both the production of profit and the reporting of that profit, did not disappear from the industry after Barings. It adapted. It moved to different instruments, different jurisdictions, different names on different account numbers. The number changed. The structure did not. The 1995 report identified the mechanism with unusual clarity. What it could not do was compel the industry to treat that clarity as anything other than a historical footnote about one rogue trader on one exchange in one city. One man, one account, 5/8. That was how it was filed, and that was how it was forgotten. Barings had survived the Napoleonic Wars, 2 world wars, and more than 2 centuries of financial crises. It did not survive the failure to read its own management accounts with sufficient attention. The most dangerous document in the building was not a derivatives contract or a margin call. It was a routine internal report that nobody in London ever read closely enough to question. And if you scroll to the last document shown on screen before the end card, you will see the precise column heading in that report that, had one person circled it, would have put the figure at £827 million in front of the board before a single yen of real money was lost. The historical record on Barings is settled enough in its facts and contested enough in its implications that the inquiry report still reads like an open question. What the record forecloses definitively is the claim that no one could have known. Someone could have. Several people nearly did. If this got you, the next episode on this channel is about the collapse of Credit Anstalt in 1931, the Austrian bank whose failure in Vienna set off a chain of banking crises that spread across Europe in a matter of weeks.